Welcome back to Talk Business and Politics. Presidential politics have put the spotlight on big banks once again. The sixth largest banks in the country right now holds $9.7 trillion in assets. That's compared to $7.2 trillion that they had before the crash. Now, that has some worried that once again, these banks are too big to fail. Others say that the reforms of Dodd-Frank are having unexpected consequences on small community banks. Congressman French Hill serves on the House Financial Services Committee, and he joins me now to talk about this issue. It's an issue you've been talking about for a little while, but it's certainly making a lot of folks perk up in the presidential campaign this year.
Right. Well, I think Dodd-Frank, which was the Reform Act that was put in place after the crash, has allowed our big banks to get bigger. And we still have too big to fail in our country, despite Dodd-Frank. But the negative effect of Dodd-Frank is it's really hurt our small, locally owned and smaller financial institutions through the overburden of its parameters and its requirements.
I've heard just from people in general, just in talk, I've not seen any facts to back this up, but that compliance departments are the biggest departments growing in the banking industry right now just because of all of the regulations. Is that something you've heard as well, or is that something you think is true?
I have seen that, and there are studies. There was quite a well-known Harvard study last year that talked about the increase in expense at banks to try to comply with the avalanche of Dodd-Frank rules, which are only about 60% implemented. That's why we're hearing about this now rather than 2010, is the requirements of the act, the burdens of the act are now manifesting themselves all over the economy.
Tell me a little bit about what should be done, because on the campaign trail, they're talking about Bernie Sanders wants to break the banks up. Hillary Clinton talking a lot about no-doc mortgages. That's a concern for her. And just different people throwing in ideas. What are you guys at the Financial Services Committee talking about, and what's the oversight there?
Well, I think we're very sensitive about the burdens on Dodd-Frank on the consumer. It's been made more difficult to get a consumer loan and more expensive. It's more difficult to get a home mortgage and it's more expensive. And the paperwork burdens are falling on the consumer. The loss of products are falling on the consumer. So sure, the banks are inconvenienced by this expense, but the real burden of Dodd-Frank, I think, is on the individual customers, farmers, small business people, and homeowners.
Yeah, farmers in particular. In that study that you mentioned, the Harvard study, they said agricultural loans will be harder to get because the community banks are the ones more inclined to loan to agriculture.
Right. And about 75% of all ag loans are made through local community banks, and they are the ones bearing the brunt of Dodd-Frank. It's hard to get through the paperwork to get a qualified mortgage. The paperwork is expanding, and many farmers are highly leveraged, and that makes it more difficult to get that community bank loan. Plus, it takes a lot of expertise to make ag loans. And we've made it tough for community banks in rural areas to even stay in business. They're losing profitability because of compliance costs, and therefore we're losing community banks about one a month in the last couple of 3 years. So we are losing these banks after the crash, not during the crash, but after that with the Dodd-Frank impacts. And I think rural areas are taking it harder.
So what should be done about this?
Well, one thing we've tried to do is we've tried to change rules like on high-cost mortgages to make it easier for manufactured housing is a big part of rural America because you don't have stick-built home builders out in rural America. They often buy a manufactured home. That was hurt by Dodd-Frank. We've changed the rules to make them more available to people by lowering the high-cost mortgage standards that were in Dodd-Frank. And also, we've tried to redefine what is rural. We are now letting rural counties protest that they're being named non-rural, like out in a good example here would be around Scott. Some of that area might be deemed metropolitan now, and if so, it reduces certain mortgage programs available to people that live in those kind of counties.
So those are incremental changes, but as you said, there's still 40% of the regulations still to be imposed.
Right. I believe Dodd-Frank, it's a technical term, but I believe that it was an overreaction to the market crisis. And the people who did not create the crisis, the big Wall Street investment banking mistakes that were made, are being disproportionately penalized by Dodd-Frank. That's the challenge. And the House Financial Services Committee is on the front line of trying to roll back those extra burdens that we think are hurting the consumer and the borrower.
Any chance that because this has become such a big issue on the campaign trail, that we'll see some reforms if, when whoever it is that's elected into the new presidency?
Right. I hope a new president will know that this is an important constraint on our economy. You know, we have interest rates basically at zero. So we've done all the monetary stimulation that we can. So we're left with non-monetary policy challenges to get this economy growing faster. And one of those is the constraints we've put on credit to consumers and small business. And that at the heart of it is the Dodd-Frank story.